Hey, welcome back to The Dive. Today on the show, we have the CEO of GraniteShares, Will Rhind. He's going to share his thoughts on Japan tweaking its yield curve control policy, the Fed's possible next move, his stance on the recession debate, shorting Tesla with the GraniteShares ETF, what he thinks will come of all this recent crypto news, the energy markets, his top commodities for 2023, and we're going to get his outlook on gold for 2023. Hey, Will, welcome back to The Dive.
Thank you. Great to be back.
Okay, so Will, the Bank of Japan tweaked its yield curve control policy, allowing the 10-year Japanese government bond to move to 50 basis. What is your read on what's happening here?
Well, it was a bit of a shock for markets overnight, certainly, who had kind of expected them to maintain this policy that they have been of really trying to keep interest rates at zero. So that was a bit of a surprise. But it seems like the market's willing to shake that off, at least at this stage. But it's going to be very, very difficult for the Bank of Japan in this environment to maintain that policy of defending the yen while all other major currencies seem to be adopting the policy of rising interest rates.
Okay, now let's talk about inflation. The November U.S. CPI print came down to 7.1% in November. The bond market seems to think that the Fed's rate hike cycle will be short-lived. Where do you see the Fed going from here?
I think that, I at the moment don't really have any reason to really believe that it will be much different from what they've already telegraphed. So we'll see interest rates continue to rise, albeit at a slower pace than these super hikes that we've seen really up until the last one, of course, of 50 basis points as opposed to 75. And so I think it's really now more of a question of the terminal rate and where that ends up. And like you said, how long? So inflation's largely been priced into the market at this point. The interest rate hikes have been priced into the market. And so really it's just a question of where that terminal rate lies. And I think around that 5% mark. At the moment, no real reason to believe it will be much different to that. But of course, economic conditions ultimately are going to be the major test of where we ultimately get to.
The majority of economists are saying that the U.S. economy will go into a recession by next year. Do you agree with this? And what are the indicators investors should be looking out for?
I think there's a strong probability at this stage that will happen. And the reason being is that inflation's largely priced into the market, interest rate hikes largely priced into the market. And really the one thing that's not is the actual earnings themselves. And so far, earnings more or less have been pretty robust across the board, albeit guiding down in terms of expectations. But really, I think for us to get into this recessionary mode, we have to start seeing earnings disappointments across the board. And I think that will happen at some point next year, especially with interest rates continuing to rise. We already have seen the impact on financial conditions. We already see the economy slowing down. And I think it's really just a question of when next year that happens.
Using your ETF, GraniteShares investors can get leverage on a long trade to go short Tesla. Recently, Tesla has been trading below $150 for the first time in more than 2 years. What is your read on what's happening with Tesla now?
Well, this is a great story. And I think part of it is to do with clearly just the macro environment, just more broadly. Tesla clearly is a company that, has been the beneficiary, you could argue, of a lot of the macro trends over the last few years. And certainly from a valuation perspective, was priced to perfection, you could argue. And that's all starting to readjust or reprice, not just, I think, in the light of rising interest rates and certainly the China situation, which has, of course, affected production. But I think certainly the takeover of Twitter and the CEO's activity or seemingly perhaps stretched time between these two kind of ventures is causing some angst, I think, at the market. I think we're kind of in a stage at the market where people are really trying to be more cautious or willing to take less risk at this stage. And so perhaps before Elon Musk and Twitter and or Tesla would have been given the benefit of the doubt. Perhaps now we're in a situation where people are sort of shutting up shop for the year. And so that's not really the case. But I think, we've certainly seen, like you said, with the leverage products, people taking interest both on the long side with TSL, which is our leverage single stock ETF on the long side, and then TSLI, which is the inverse of that. So provides a potential for positive return when the share price of Tesla falls. But both of those have gathered significant interest. And obviously from two camps, people that think that it's a buy the dip opportunity for Tesla, and those that still think that the stock is overvalued and perhaps might be subject to even more declines based around liquidity requirements or other external factors relating to the Twitter deal.
You also have a product where investors can get leverage on Nvidia. How much exposure do you think Nvidia has to the recent crypto news?
Well, I think Nvidia is one of those companies that spans, different aspects of the tech world. I mean, clearly they're involved in GPUs, which is, a key element in AI or artificial intelligence technologies, as well as gaming. Also, a lot of the Nvidia technology has been used for crypto, as you rightly point out. So there is some exposure there, but I think by far and away the major influence in terms of their business is much more in the AI space, the gaming space, which, as we've seen with everything related to tech, has come in this year on the back of rising interest rates and inflation and worries about the slowdown.
Speaking of crypto, let's talk Coinbase. The CEO proposed regulatory framework to oversee crypto in a blog post. How long do you think that it will take to restore crypto's investors' trust?
It's a really good question. I mean, I think that word trust is really at the core of this whole issue. And clearly with any investment, there has to be trust. And I think that it could be some time, and it might not happen. We have to be realistic that it might be the case that trust is really never restored for the bulk of investors that were in this market. And so that is a major X factor. I think, what will most likely happen is that, we will be able to move on from this crypto or move on for this. It's really just a question to me of where that marginal dollar comes from in terms of investment or activity in the space. Going back obviously to last year and certainly in the run up to the top that we saw in Bitcoin and other cryptocurrencies, clearly there was a lot of speculation happening in that market. People arguably had excess cash and were using that to speculate in the crypto market. Now that people have a lot less cash, a lot of people have lost money, perhaps lost everything in certain circumstances, but their ability to invest more is certainly less now than it was. And I think the scandals that have happened within the space, shaking confidence, are really kind of the final nail in the coffin. And so taking a step back is really a question of, I worry about where that marginal dollar comes from. And will those people be willing to back Bitcoin, other cryptocurrencies in the same way they did before, or are they just going to go out and buy shares of Amazon or something else that appear to be at a discount? In other words, is crypto necessarily the best speculative play anymore in an interest rate environment that could be as high as 5% nominal rates? That's really the key question for me, is just, will we see that speculative activity return? And indeed, do we have to see that return in order to see Bitcoin and other crypto prices, materially higher from where they are today?
Do you think FTX's collapse could be a good thing for Coinbase?
I suppose in some respects, it's a good thing in the sense that I think onshore investors, the offshore investors, I think there's a different story, but the onshore investors who are using or are thinking about using FTX US clearly now will have no alternative than to seek somebody else to use. Coinbase, I think, stands out as a company that is the standard bearer, if you will, for U.S. onshore kind of activity. I think that from a speculative point of view, in terms of people opening an account, etc., Yes, I think people will still want to do that with a trusted party, and I think they'll stand to benefit. It's really more of a question to me of whether that activity will still be there. And I know there are different parts of Coinbase's business, like custody, et cetera. But again, that still relies on new participants coming to the market and participants committing even more capital to the space. And really, I think that's really the big question at the moment is, when that comes back.
Shifting to commodities. In the EU, countries have agreed to cap natural gas prices if the Dutch title transfer facility in Amsterdam exceeds 180 euros per megawatt an hour. What impact do you think price caps will have on the energy markets?
I think it's too early to say, really. It's a little bit like the European cap on Russian oil prices, where you could argue on the one hand that we haven't really seen much change or much difference in the market, but I think on the other hand, we have seen certainly instances of particularly Asian buyers, taking advantage of those prices, and indeed confusion even in the European markets with regard to how sustainable or how players will be able to actually meet those caps going forward, because it's not really the way that the oil gets transacted on the global markets. In other words, once shipping and forward pricing is taken into context, the price that ultimately people pay when the barrel of oil is delivered is different to when it was first sort of negotiated. So I think time will tell as to whether it will make a difference or not. But certainly it seems to be a big policy objective of the European Union and to have these caps on oil and gas prices.
Which commodity do you believe has the most upside potential in 2023?
I think when you look at the different commodities, energy, I think will remain strong. We've seen, despite chances or despite all of the talk of a slowdown, when we have seen oil and gas prices fall, at the same time we've seen the supply issues kick in, and blocks like OPEC Plus, for example, threatening to come and cut production. But I think if we're talking about that kind of environment for next year, I think energy will still be a strong market for next year. I think there's a chance, obviously, that if China really reopens and starts to stimulate, like people are speculating at the moment that they are, and if that's sustainable, then we could see big bids under some of the more traditional commodities that China really likes, such as copper. But at this stage, again, it's difficult to say with any certainty whether that policy of China opening up will be sustained or not.
Okay, before we let you go, Will, we'd like to get your gold outlook for 2023 as well.
Well, I think if you said to me even 6 months ago that could you see a situation where we'd be almost at the end of December and gold prices be above $1,800 an ounce, and I think that if you'd asked me then, I would have said no, on the back of what we saw really throughout this year, which is gold struggling in an environment of really dramatic interest rate rises and an incredibly strong dollar that hit multi-decade highs, and really was the main stumbling block to gold not going a lot higher in this inflationary environment. I think if you look at the dollar and you look at the dollar in relation to gold, and you see that the dollar peaked a couple of months ago, whether that's the absolute peak or not, we don't know. But in that time, the dollar's backed off as the interest rate, the velocity of interest rate rises has slowed, and people start to speculate about where the actual terminal rate's going to be. But I think if we're in an environment where the dollar's going to be softer or more stable, we're in an environment where that allows gold prices to appreciate, particularly where we have two things working in gold's favor. One, there's still inflation in the economy, and we expect inflation to be higher than it was before, even though it will come down from these sort of very high numbers that we've seen on the CPI. And then number two, we're going into potentially a recessionary environment on the one hand, and it could get worse even than that. In other words, it could be a scenario like 2008, where in an economic crisis brought on by activities, particularly in the housing market, but this time around just more recessionary activities from higher interest rates, we could see gold being a flight to quality asset like we did see in 2008. And therefore, we see another source of demand coming into the market as people look to gold as a way to hedge portfolios against an equity market or a bond market further declined in those two markets. So I think gold is set up quite nicely here. I think the major risk for gold at this stage appears to be, if not over, appears to be diminished, and that was the impact of the strong dollar. And really, it's a question now of what impact will a recession next year have on the metal. I think at this stage, gold could be seen as an asset of the highest quality if we get into a situation where people worry about credit and counterparty risk again.
Well, that's all we have for you today, Will. Thank you so much for taking the time to come on and chat with us. I hope you have a great Christmas and hopefully see you in the new year.
Yeah, thank you so much. Happy holidays to you. Great to see you again. And thank you so much for having me back on the show.
Thanks so much for watching today. We will be back again tomorrow, so be sure to stay tuned by hitting that bell and subscribing below before you leave us. Bye.